You're watching All About Money on HKIBC. I'm Isabel Wong. China's grand plan to integrate 9 cities in Guangdong and Hong Kong and Macau to create a megapolis isn't providing the kick to property investment. That's according to Knight Frank. The global property agency also said cross-border real estate investment into mainland cities in the so-called Greater Bay Area is going to fall as much as 33%. Moody's Investor Service also said new home sales in Hong Kong may fall as much as 10% to 15% by value. So other than Hong Kong and the Greater Bay Area, where are the opportunities? Let's bring in Amous Lee, FM Investment Group CEO. Amous, welcome to the show.
Hi.
We have lots of questions for you today, but first of all, let's start off with Hong Kong.
Sure.
Because the Hong Kong property market is projected to fall even more, and then it just recently posted its first decline in 28 months in September. So what do you think is triggering such change of sentiment and prices?
Well, number one, because you see, Hong Kong is a property market, is always a very unique market by itself. It's been up there for forever, you know what I mean? And it's been always breaking a record high. So for time being, to be honest, I think there is a price adjustment really from the tip-top side. None of the market or none of the property could always be on the bull side, right? So it has to be adjusted. And given that stocks markets and all those now the China and US trade war, so it does bring down a bit of confidence level in the investors. So people are putting it more on hold kind of basis rather than really just keep on buying it. So a bit of softening, a bit of adjustment, I think it's purely normal. If it's going down next year, I think that might be a chance of going down in the first half of the year. But to really what I call slam down, I don't really think there's a big dip down, but there's a slight adjustment. It seems to be normal.
Mm-hmm. So in terms of diversifying their portfolios, one of the options is definitely real estate. Some people even consider it the safest. So I know that you are an expert in the overseas investment front. So given the global economic slowdown and also the situation of US-China trade tensions, have you seen any downturn in terms of demand for overseas properties?
Well, for 2018, the first few half of the months, in the year, it's been pretty good, pretty solid. We see a substantial increase of overseas investors coming into overseas market, Hong Kong investors especially. Over the last 1 or 2 months, yes, you do see that there's a bit of slowdown in the overseas property demand market, but very strange market at the moment. It's either the mass market that's doing super well, still doing very well, or the high-end market that's doing well. It's the kind of mid-tier market that people are a bit more hesitating. Should I spend or should I not spend? Kind of investment. But however, given that the current scenario, people would think that, well, with kind of money, what can I get in Hong Kong? What can I buy in Hong Kong? Well, even the cheapest property in Hong Kong is still relatively expensive. So can I take the same amount of money to buy something decent as a first-time investors, as overseas investors? Can I get something? Can I, get my money more returned from there? Whether it's from rental, capital return, and one more very important thing is the currency exchange. Given that Hong Kong dollars is back to the US and US dollar is getting strong at this moment, so should you take the opportunity now, that given that US dollar is still strong, to basically buy in some other overseas property when the currency is low? So that could be, another kind of investment strategy.
Mm-hmm. You just mentioned some markets that lie in the middle. They are suffering from a slowdown. So what exactly are those markets?
Well, basically, you see that the property prices, I say that, something like between slightly more than 1.5 million Hong Kong dollars to about 2.53 million Hong Kong dollars. That's what I call the middle-tier market. Why? Because below 1.5, you can get nothing in Hong Kong. Basically, nothing you can buy in Hong Kong. And above 2.5, you might be able to buy some car park in Hong Kong. So then you will have a mindful thinking that, should I put this money into a Hong Kong car park? Should I buy an apartment in somewhere else in Bangkok or Japan? So this is a kind of a thinking. I don't think the hesitation comes in stopping them to invest, because investments need to continue, but whether they should buy A or B, the kind of investment skill. Thinking that people are at the moment.
So during a time where the global economies are suffering from the US-China trade wars and also so much uncertainty, why do we still invest in overseas properties?
Number one, as you said, investors still like to buy property. Property is one of the most, so to say, preferred, so to say, assets that whether it's Chinese or whether it's investors like it to keep as a portfolio. And also given that, look, property is only probably one of the most best leverage investment tool, for a lot of overseas investors, right? For $1 million cost property, you just need to pay probably 30%, 40%, and given the 5% rental yield, 6%, it's still relatively, safe. That given that you have a property, a solid thing, and then with a proper rental in place, it basically can give you generate you a stable kind of income. And also, as I said, a lot of people is thinking to do forex exchange, for example, using US dollars, but just by changing US dollar with yen, for example, or Thai baht, or even UK sterling, why you might as well buy a property. Because buying a property, you can use that money to do a leverage, to buy something bigger. And in fact, you can still do your rental yield, and at the end, the capital growth. So kind of like three in one kind of investment rather than just the currency itself.
Mm-hmm. So what about your clients? Do they have any concerns right now, and what are you advising them to do?
Sure, I think concerns, well, when it's good time, bad times, there are always concerns, Good time, they'll ask you, when do you think the thing will drop? Bad times, do you think it gets worse? It's like they always get concerns. I think the major part that we advise our clients is basically asking what are the investment, timing, for example? Are you looking in long, short term? Are you looking into a more stable market rental side? Or are you looking for a more substantial capital growth kind of thing? And also overseas investors sometimes buy properties, not only just for basically their investment. They basically buy for retirement, for schools, for the kids, and also some migration kind of purposes, right? Mm-hmm. So different category fits in different shoes. So basically, we will consult the client and ask what they want, and does it fulfill them, their needs. So that is one part that we always look into.
Mm-hmm. So is there anything that you're watching or that you see at the moment that other people are not really talking about?
A lot of time. Basically, number one, for example, currency, foreign exchange. Always people, for international buyers, always forgotten about that. For example, you are buying a property let's say it's 20 million yen, right? 20 million today is not 20 million yen 4 years ago, where the Japanese yen was high, all-time high, because we are earning Hong Kong dollars or US dollars. So basically, a 20 million yen property probably costs you now 1.4 million Hong Kong dollars, rather than those days, it's 20 million yen, but it costs you 1.8 million. So that's 400,000, 2 to 400,000 cheaper than a couple of years ago. The sterling, the currency exchange part is what I always call it tax-free, because it's basically a foreign exchange gain, isn't it? Mm-hmm. And exchange gain is basically tax-free. So that is very, very crucial for what I get in and buy. And also, depending on the market, I always believe that there's one market that's upside and downside. As mentioned, I've been involved in UK for more than over 10 years. I've seen it up and down and up again. For example, the Brexit for me is an opportunity. Every crisis sometimes to me is an opportunity. Mm-hmm. So sometimes we just got to do our homework. Right. We're just going to make sure that a few factors are where we need to think, and when we come into the market, or where we think that we need to exit.
Mm-hmm. So in terms of the global property market, where are the bright spots? Where are the opportunities?
Well, I should say the flavor of the month or of the year at the moment is really Bangkok property. Bangkok, Thailand property has been really booming for the last 2-3 years. Hong Kong investors, Taiwan investors, China investors, Singapore, Malaysia, even Japanese are buying into Bangkok. Mm-hmm. So this is one of the booming market that has been really on bull run. And on top of that, Japan, Tokyo, Osaka is also one of the property market that has been starting to see a booming for the last 2 years. UK side also, but not just in London anymore. Those days, just people just talk about London. But now the other cities are also coming up. So these are the few sectors that I'm looking into it. Mm-hmm. But apparent from that, I also look at some of the new markets that I'm having an attention to look at. It could be Malaysia, because Malaysia last year, if you ask me, I'll tell you now, I'm not going in. The political instability and all those things. But given that I see a new government coming in and Malaysia property prices still relatively cheap, so I think it's now a time to look into it, mm-hmm. And then I can study it a bit more and then to advise the clients.
And why Bangkok, why Thailand?
Well, number one, I think Bangkok is in one of the most popular tourist area, for all the Asian or even for the expats, right? Given that the things that are cheap, living lifestyle there is a lot cheaper, property prices, and also the China with Thailand relationship, the One Belt, One Road kind of story, investments direct from China. This created a lot of those what do you call it, investment opportunities. Whether it's infrastructure, they're building a lot of those train lines. As you know, Thailand for its what? Traffic jam. You know what I mean? So they're building a lot of train lines, tube lines, to increase, basically, to make sure that to improve the infrastructure. And apart from that, the One Belt, One Road will bring in a lot of hot money from China flowing down. And also, they're going to create Thailand as a 4.0 kind of a smart city, smart hub, whereby you can be very technology-based kind of thing. So, and given that the price tag in Bangkok, the property is still very affordable, for a lot of people in Asia. So Thailand become one of the really hottest spots for a lot of investors now.
Amous, hold that thought. We'll come back to the conversation in a minute. Well, Amous will be staying with us, but still to come on the program, cooling measures have hit the global property markets. So what's ahead in 2019? Do stay tuned. Welcome back to the second half of All About Money. Well, real estate has been referred to as the single greatest asset an investor could buy, but property markets worldwide have recently found themselves subject to stiff cooling measures in light of the escalating trade tensions. So what's ahead of the global property markets? Let's continue the conversation with Amous Lee, FM Investment Group CEO. Amous, in the second half of the program, so we focus a bit of the Hong Kong market. So now, let's go global. We focus on the UK. So in terms of the UK, they recently announced in the autumn budget that they might be looking to increase the stamp duty by 1%. But given like more than half of the UK residential property investment now originates overseas, with China and Hong Kong investors among the biggest groups. So do you see, what do you think about the current situation of the UK market, like in light of Brexit and all the uncertainty?
Sure. As I said earlier on, that Brexit to me is actually an opportunity because I've been in this over 10 years in UK property market. And one thing before the Brexit I was a bit worried was that the sterling was high, was really high, and then the rental yield in London was low. Property prices were high. And even the interest rate were high. So, but given the Brexit, to be honest, the number one thing is that I feel that the sterling exchange has dropped about 30%. So that's a substantial drop. The property prices have started to come down. And apart from that, you get to see that UK would still be one of the, a lot of Hong Kong investors, or even now growing these Middle East or mainland Chinese, they still love UK regardless, because one of the things don't change is education, right? The education thing, whether if there's a Brexit, you will send your kids to good schools, good uni. I think that's unchanged. So the number two to me is just that investors are different now. Instead of just looking at London those days, just London, they look at the outside cities now. Cities like Manchester, cities like Birmingham, Cambridge, Oxford are very, very on hot demand, given that a much cheaper price, right? And given that the stamp duty is a lot cheaper, and even with the 1%, let's say it goes through, the 1% for foreigner, the 1% don't really buy, to be honest. Unlike like Hong Kong, even 15%, people are still going crazy, right? Singapore is 15%, Australia is also like 7-10%. So the 1% don't really bite. I just think that there's a bit of difference between the local with the overseas investors. I think what really concern is when does this Brexit really exit? Uncertainty is always a part that I feel that investors are concerned. Whether it's a good news, bad news, so long you digest the news, you move on your life, right? And for Brexit, for me, is really the banking industry, right? People are all worried about the banking industry. But I keep asking myself one thing. Would the banking industry be migrated to other parts of Europe? To Germany, to Italy, or to even France, given that English-speaking, unfortunately, UK, or fortunately I call it, using English, a more international language where the banking industry needs. So just to migrate the whole system in UK really cause a big trouble. So I think that nobody would change. I don't think UK would change their position in the financial sector. And so I think the rental and things, just wait for the news to be digested, investor will still be back. London is always London. But given that outside London is created another opportunity for the second tier or the second city or third city in UK.
So what's on offer in the London and the UK markets at the moment? Like, are they just luxury apartments, or like what other product categories are there?
Well, in London, very much like Hong Kong, nothing really cheap, nothing really cheap. So basically, but the developers, I should say, are a bit more, not as aggressive as before. So prices are basically go deep down for about 15 to 20% over the last 2 years since the Brexit. I think it will enter the point that, look, the prices were stable and start going up again once the Brexit news, digested and confirmed. But apart from that, that's why you get to see investors, smaller investors or new investors are coming in to take it as an opportunity, actually. What you buy today in terms of sterling exchange is 30% cheaper. What you buy today is probably cheaper than you buy a year and a half ago. So they will also look at second-tier city like Birmingham, Manchester, given a much lower price and the rental yield is much better. So those investors are looking for.
Right. So I would like to talk about another favourite of Hong Kong investors, which is Australia, because recently HSBC Australian chief economist said the housing prices in Sydney and Melbourne, they are expected to drop by like 12 to 16%. And also analysts of Colliers International also said that property bubbles are in danger of bursting down there in Australia. So does that mean it's a no-go for the Aussie market?
I feel, in fact, 2 years ago, I started to almost slow down or really exit from Australian market. The same reason, as I mentioned, at that moment, where the Aussie property were pretty high, the Aussie dollars were pretty strong, and the banks were actually lowering down the leverage, the mortgage. So this is a kind of signal to me that we should start moving out. And given that with the additional stamp duty to the overseas investors, I think the reluctance to go and invest into Australia now is really, really high, as in people are reluctant to come in as investors. But as an end user, it's totally different. As you know, there's a lot of Hong Kong people are related to Australians, to Australia. Basically, they have citizenship there, or they want to retire there, or they want to study there. They will still buy as in for their own use, but not so much as an investment side. So once the investment side is down, I would believe that the property prices will really go down, because Melbourne and Sydney has been, again, up for how many years, right? And a lot of places have become so unaffordable now, where we're so affordable those days. So I think adjustment will need to be done. And given that the stamp duty, coming into Melbourne has a big hit to overseas investors, deterred overseas investors, plus the bank is closing their doors for mortgages. So these three factors would basically really slow down the whole Australian property market.
So also in New Zealand, they also recently started tightening their regulations, that they were banning foreign investments. So do you have any comments on this?
I do. In fact, one of the things that I didn't come into New Zealand market, for some years is because, number one, the population wasn't that big. It's a big country. It's a big country, but the population is mass. So by creating that many property in New Zealand, and given that the New Zealanders, basically don't really want that many overseas investors, mainland Chinese, be it or be other nationality, they start deter. So basically, I think that New Zealand market has been really, really coming stagnant now, or it's really going down.
Right. So I know that you also think one of the bright spots in the global property markets is Japan. So can you tell us more about it? Like, what's on the market at the moment, and how is it?
Well, Japan, I think there's a few, many years, people is talking about Japan property market, and would it go up and all those things. But I always ask myself, given a first-tier city like Japan, Tokyo, or even Osaka, the property prices are cheaper than 20 years ago. Not even in worldwide, some of the tier 2, tier 3 cities are much more expensive, than tier 1, than 20 years ago. But Japan and Osaka, Tokyo and Osaka are still cheaper. So that is very, very, very kind of, to me, is a good value. And also, I think Japan is very strange, country always to invest. The reason is because, number one, I think yen playing. The yen has really also decreased substantially. Given that what you buy about 4 years ago to now, the yen has dropped 30%. And yen is also one of the currency that is very unique. Whenever the economy downturn, yen is getting strong. So a lot of time, yen becomes a safe haven due to the currency exchange market. And apart from that, there's a lot of positive news coming into Japan. For example, you see the first growth of the year. You get to see that there's the tourism has been booming. In fact, when they announced about the Tokyo Olympic, they're supposed to have 24 million tourists rushing into Japan, in 2020. But this figure was done in 2000. In fact, last year, it already hit 28 million visitors coming into Japan. So the new target market is 40 million, 40. So given the number of tourists rushing into Japan, and given that the currency remains low, I think the Japan market, for Tokyo and Osaka, will be given a lot of those opportunities for investors. And also given that Osaka would have those, the G20 meeting is going to be there, and they're also going to have a casino, planning to have a casino in Osaka. So all those are the factors that I think that can bring up to the Japan market, and banks are actually opening up. Compared to 3 or 4 years ago when I was doing my research, none of the banks were doing mortgages for Japan properties. But now, you get to see 1 bank, 2 banks, 3 banks coming up to open up mortgages for overseas investors. And that's very, very encouraging.
So I know some investors, they actually bought properties in Japan, Tokyo, Osaka, for just to rent them out as Airbnb apartments. So is the crackdown on Airbnb in Japan worrying investors at all?
I think to both sides. To those that are individual, so to say, investors that are buying, from the second-hand market, a resale market, an old property, they get worried because the strata title that don't allow them to basically operate Airbnb. Basically, Airbnb has been regulated now. There has been legalized. I use the word. For example, in Osaka, there hasn't had any restriction on Airbnb. You can rent 365 days. So there is no restriction unless your management strata title don't allow you to do so. So given that Tokyo, only certain cities, areas that in Tokyo, certain area in Tokyo, that you are allowed to do Airbnb. And also, when you have those short-term lets or Airbnb, you're only allowed up to a certain number of days. So what do you do, with the rest of the days? So given that you have to select the property much more carefully. For example, which ward is in Tokyo that allow Airbnb? Which property has been regulated to have Airbnb? So all these things, because for doing short lets, your rental yield is a lot higher than the traditional rental. And apart from that, the buyers could basically stay in their own apartments when they're there. So that helps, that encourage them to invest.
Right. So very quickly, 2019, what is it going to look like for global properties?
I think 2019, like everywhere else, I think it will be quite choppy in the first 1 to 3 months. But I think that property prices, as I say, in the general mass market, will still be running quite well. A lot of time in January, people are launching new products, and they will have a lot of attractive packages offering, and banks are still quite open on the loans. What I'm worried is about, is basically March, April, whereby the real, the China-US trade war, the positioning on that, and then the BRIC exit is going to come and all those things. But I think that investors will still take an opportunity to see that properties with good value, basically foreign exchange that is good, they will still take the opportunity to come into the market.
Amous, thank you so much for your insights today. That was Amous Lee, FM Investment Group CEO. This is it from this edition of All About Money. We'll be back right here on HKIBC next Sunday. Good night.